Hey, everybody, welcome back to the show. Hope you're having a great day. I hope you're having a better day than the market had today. I was actually typing in a question, a poll that I want to ask you guys. And then, we'll dive right in. Obviously, if you can give me a thumbs up that you can hear and see me, that'd be great. So the question is, how concerned are you about the economy? So we'll say 1, not at all. 2, mildly concerned. 3 will be concerned. And then 4 will be, I'll just say very concerned. There you go. So let's see. I got the thumbs up. Thanks. Thank you. Appreciate it. So, yeah, today was a big day in the market. I assume you guys have sort of, tuned in to the market, but here's from Morningstar, lots and lots of red, dark red. I can make this a little bigger, maybe. Growth really took a beating, but also small cap and small value was down 2.2. The Dow was down 2%, S&P 2.7, NASDAQ was down 4. Tesla took a huge beating, down like 15%. I think Nvidia was down 5. My beloved Apple stock took a nosedive. What was it down? 4.85%. That'll leave a mark. Even VXUS International, they didn't save the day. Berkshire was up, not by much, but. And another stock that was up that I was had been considering doing more research on and buying, but I hadn't, was Core Natural Resources. It was up over 6% today. I have no idea why. As far as I know, they didn't announce anything. So anyway, I thought we would start the show I'll just give you my 2 cents about what's going on. And it's probably worth maybe 2 cents. We are living in interesting times, right? That's the curse. May you live in interesting times. And while I try to avoid politics on this channel, you can't really avoid politics right now while you're discussing the economy and the stock market, because a lot of it's turning on, what's going on in Washington, D.C. And so, as I don't have to tell anyone, we've got the issue of tariffs that President Trump has imposed. As far as I know, primarily on Canada, Mexico, and China, but there could be others. So that's a big one. And by the way, I find this useful, interesting. This is from the Tax Foundation, which I guess maybe leans a little center right, but they have this page, and you can just Google it if you want to read it later or now. And they update it, and it just sort of goes through. It's interesting, some of their findings. They're of course, these are just guesstimates, but they're trying to evaluate the impact different tariffs will have on the economy, how they'll affect GDP, how much revenue it will raise. Apparently, they're saying that the current tariffs on Mexico, China, and Canada will raise revenue of $142 billion. So, but of course, then there's retaliatory tariffs, and it gets much more complicated. But I think that's sort of an interesting data point. That's sort of one thing that's going on. And of course, as you may know, over the weekend, President Trump said, yeah, this may cause some pain, i.e. a recession. And at least at the time, he didn't seem to indicate that might keep him from going forward with these tariffs or pulling them back. He seems okay with that at the moment, although from my experience, he tends to change his views on these things pretty quickly when he feels so inclined. So who knows? And by the way, I hope you can tell that I'm trying to be somewhat objective in my comments, because this really isn't a political channel. So I beg of you, please be kind in the comments. By the way, not to me. Say whatever you want, to each other. My bigger concern, well, before I get to my bigger concern, we have this other question about how strong and resilient is the economy in the United States right now. And I have some concerns in that regard. Of course, Elon Musk and Doge are working their way through the federal government. As I live in Northern Virginia, I know a lot of people that either work for the government or work for government contractors, and it's absolutely affecting everyone. Now, of course, not everyone is losing their job or taking a buyout, but for example, I was talking to someone that's in the works for a small government contracting company, which are very common in the DC area, and they haven't been paid. The government is delinquent in paying them, and the reason is that Doge has to evaluate all of these payments before they go out. I guess evaluating them for fraud. I guess that was this person's understanding, but it's forced the company to go get a very expensive, line of credit in order to meet payroll because the government's, not paid them on time. And so it's caused a lot of turmoil in ways that if you don't live here and you're not tied into it, and I'm only sort of tied into it through other people that I know, you might not appreciate this, right? And so that's sort of going on. And it just seems to me, notwithstanding the last jobs report, that employment just to me feels soft. It feels like, we could see employment going up. Now, the interesting thing about that is that if, and this is a big if, but if inflation stays in check while unemployment goes up, it's a big if, you could see the Fed cut rates more this year. And I think some are sort of predicting that may in fact happen, and that you could see 3 interest rate cuts, which of course could have a positive effect on the stock market. But of course, there could be a host of other things that have a negative effect on the stock market. And of course, some would say, well, with tariffs, won't that cause inflation? It certainly is inflationary. How much of the increased costs get passed to consumers? Big question. In any event, the thing that concerns me the most is this right here, and I'll show it to you. This is our budget. This comes from the Center on Budget and Policy Priorities. I don't know if these are these are 2023 figures. So they could be a little different. Well, they will be a little bit, but you'll see that we spend roughly 50% on health insurance, which I assume includes Medicare, Medicaid, veterans, and maybe other things, 13% on defense, and then 13% on interest. I mean, those are just big numbers. That's what, 70, 80%, 70%. Let's see here, 45, 55, 58, 68, 71% of our budget goes to those 4 categories. That's just a big number. And there's already talk about how Treasury is going to deal with this. Apparently, a lot of our debt is coming due, so we'll have to effectively refinance that. And they want to, rather than refinance it with short-term debt like T-bills, they want to go longer duration on that. Some criticize the past administration and Janet Yellen, saying they should have done that then, but there were reasons they didn't, and I don't know who's right or wrong. But longer term, that's frankly a bigger concern for me than, say, tariffs. I mean, tariffs can be undone, right? President Trump can undo them now. You got retaliatory issues, so there may be some complexity there, but the next president could undo them. It's interesting that Trump put in tariffs in his first administration, and when President Biden came in, they left them in place. So I gather from that President Biden's and his administration felt similarly to President Trump, at least with those tariffs. These are obviously new and added on, so we'll see. Having said all of that, and then I'll stop talking and get to your questions. If you have a well-diversified portfolio, which for me means bonds, stocks, maybe a little bit of cash, but that's not even all that important in my mind, and international, I don't think there's anything to do. I think, you go about your day. I certainly I didn't sell anything today. I don't plan to. I haven't changed anything about my portfolio. Of course, this was just one day. And if you've been investing long enough, you know that, this is just one of many down days that we'll experience as investors. And we could experience and have experienced much worse, right? But it'll be interesting to see what happens over the next 12 months, because U.S. stocks are richly priced. We have a lot of, I would almost call it chaos. There's almost part of me that thinks President Trump, he certainly doesn't mind creating chaos. And he may have good reasons for it. I'm not going to get into that. And you could agree or disagree with different things he's doing, but he certainly doesn't appear to care about upsetting the apple cart, whether it's with long-held relationships around the world, if it's with tariffs and trade agreements, if it's with how we just run the federal government. And so when you inject that sort of uncertainty into the market, markets don't like that. Businesses don't like that, right? Businesses don't want to, and they're less inclined to invest in uncertain times. By the way, no different than you and I. When things seem certain, of course, they're never as certain as we think they are. But when things seem safe and the market's going up and interest rates are reasonable, people are buying houses. They might be starting businesses. They might be spending a little more for that next car. And then when things get, sort of uncertain, what do? We tighten our belts. We're like, I'm not sure I want to go into that debt, or that I want to spend that money. Businesses are no different. They just have more zeros at the end of the numbers. So at the end of the day, I think there's just sort of a lot of chaos right now. And so we could see a volatile market. We should expect that. But two, I don't see any reason to change what we're doing, assuming we've got a well-diversified portfolio. So there you go. That's my take on it. Let's see how let's see where the poll stands. It's evenly split. So right now, the 37% of you are mildly concerned, but and 16%, you're not concerned at all. Nothing to see here. But 26% are concerned. 20% are very concerned. That's over 700 votes at the moment. One of the things that I find interesting about my YouTube channel and this live show in particular is that, I do this show usually every other Monday for those that are maybe new to the show. By the way, if you want to ask a question in the chat, just tag me my name. It helps me find your questions. But what I've noticed is that when the market has a bad day, and we can call today a bad day, a lot more people tune into the show. There's right now almost over 1,400 people watching this concurrently. And there's already been 2,000 views. I've been on, we've been on here 10 or 12 minutes. And I get it, right? People are worried and they kind of want to find a place where they can talk about this. And so hopefully this is a good place to do that. Keep the discussions back and forth with one another productive. What I try to do in my own sort of analysis, really of anything, but related to money, investing, is to try to always stay curious. Hold my views lightly, stay curious, try not to come to these things with my mind made up, whatever it might be. And anyway, that's how I try to do it. Sometimes I fail, by the way, at that. So that's my family. Okay. Whew. I don't know if I've skipped any. I might go back because there's a little lag between, and you don't know what I'm pointing at. So I have one monitor here that shows YouTube and all the comments. Then I have another monitor here that allows me to put the comment on the screen so you can read it too. And they're not 100% synced up at the beginning of the show. I don't know why. Okay. Ethan says, with a 2-bucket strategy, and I'll describe what that is in a minute, does one ever strategically choose to not sell assets and use cash instead, or is that market timing? So the idea of a 2-bucket strategy, and there's a 3-bucket strategy, but these are it's a way to manage your investments. It's one way to manage your investments in retirement. And the idea, the 2-bucket strategy is sort of how the bucket strategy originally began. Harold Avinsky is the name of the certified financial professional that sort of came up with this idea, and I think gave it its name. He's been on the show, so if you want to hear his interview, you can just search in the show for his interview. And he had a 2-bucket strategy. And so in bucket 1 was just all your investments, stocks, bonds, whatever asset allocation you have, 60-40, whatever. And then he had a second bucket that was just cash. And he did it because he found that a lot of his clients, who were retired on a day like today, for example, they were scared to death. What's going to happen All my money's in this investment portfolio. I need some breathing room. So he said, okay, I'm going to pull 2 years worth of expenses. And I think the way he did it, this would make sense to me, is the 2 years of expenses that you'll need after factoring in Social Security, pensions. How much do you need to take out of your investments every year to top off whatever you need beyond your guaranteed income? We'll take 2 years of that and put it in cash. So we're going to take it out of the investment portfolio, stick it in a checking account, or probably a high yield savings account. Today, you might put it in T-bills. You might put it in a T-bill ETF, something that earns a decent yield, right? And that just helped his clients sleep at night. Now, what he found was that that's a real drag on the performance of the portfolio. Maybe not every day or every month, but long term. And so what he found was he could actually reduce that bucket to 1 year, and his clients were happy with that. So that's where he ended up, 1 year. Now, to answer Ethan's specific question, he did not use that as a way to not pull money from the investment portfolio. It wasn't like, well, if the market's down like today, maybe it's down for the next few months or whatever. He wouldn't say to his clients, okay, just spend down the cash bucket and we'll just leave the investments alone. That's not how he set it up. And so what he would do every quarter is refill the cash bucket. And so in that sense, it was zero market timing, right? Now, what has happened since then is that others have come along and said, well, let's maybe do some more things with the bucket strategy. Let's have a 3-bucket strategy, not just 2. And the difference would be, we'll take our stocks and bonds that were in bucket number 2 with Harold Avinsky. We're going to separate them into 2 different buckets. So we'll have a cash bucket, a bond bucket, and a stock bucket. We'll have some number of years of cash. And for most people that follow this, that I've talked to or read about, they tend to have 3 or 4 or 5 years of cash. It's a lot of cash. But let's say 2 to 3 is probably, I would say, the most common. Then they might have 5 to 7 years of bonds, and then just the rest goes in stocks. And I have found that for that crowd, they will often spend down the cash, spend down the bonds when the market's down. Now, they wouldn't, I don't know that they would do it on a daily basis, right? They're taking money out once a month, once a quarter. But yeah, they actually do follow that approach. I'm not sure I would label it market timing. I guess strictly speaking, it is. But, there's market timing and then there's market timing. Now, like a day trader, that would be the extreme case of market timing, right? At least from my perspective, it would be. And they certainly are not, I wouldn't describe the 3-bucket strategy like that at all, right? And in some ways, it can be really hard in retirement. The idea is when stocks are down, not only shouldn't you sell them, but you should take your bonds, sell them, and buy more stocks, right, to rebalance. For some people, I think that can be a really, really hard thing to do because your stocks are already down. You're already nervous. And now I've got this safety net, cash and bonds. And you, Rob, you're telling me I should sell part of my safety net and stick it in stocks that have been falling? Well, that's rebalancing, right? And some folks might just not be in a place to do that. And so if you're not, I would say probably at least not spending your stocks is probably the next best thing, right? So anyway, that's kind of it's a long-winded answer. I'm sorry. So what happens is the chat over here goes up and I can't get back to it. So I'm going to come over to here where I can see all the chat. I just won't be able to put the next few questions on the screen. And for that, I apologize. I have to figure out if I can get an answer to that. Okay. This is from John. I don't know if this is a question, but I like it. He says, I'm my daughter's financial advisor. You put that in quotes. So I'm guessing he's not, like a certified financial planner, but I'm my daughter's financial advisor. Of course, today she said, quote, all my money is gone. It does feel that way, doesn't it? This is long-term savings. What words do I use to calm my inexperienced daughter? Oh, there is a question. That's a really good question. So I think of it in a couple of ways. The first is, and I would say this to all of you, and I would say this to my wife, although my wife has no clue, by the way, what the stock market did today. I should tell her after the show. Hey, honey, guess how much we lost? The first thing to tell them is what happened today is very, very normal. It's absolutely normal. Of course, it doesn't happen every day, but it's a very normal part of investing and the market, and it will happen again and again and again and again and again. And there will even be days that are worse, and there'll be a lot of days that are of course good or very good. And so that's the first thing I try to tell them is it's normal. And to the extent that you have a little bit of knowledge of the stock market and its history, you could share some of that. You could talk about October 1987 when it lost, what was that, 21% in a day, something big. You could talk about the dot-com crash and 3 years of losses. You could talk about 07, 08 into March of 09, I think is when it hit bottom. We don't have to go that far back. We can talk about COVID, and it was down, it was down, what, 8-10% in a day? It was significant. So that's the first thing is this, this is not unusual. It may feel it at times, but it's not. It's not unusual. It's a normal part of the process. And the second thing is, particularly for younger folks that are still working, is that, you could explain to them when you make that next 401k contribution or IRA contribution or whatever it may be, you're buying that mutual fund or that ETF or that stock at a cheaper price. You're getting a better deal. It doesn't feel good because you see your balance go down. But really, for a young person, if you're in your 20s, you want the market to crash and keep crashing for the next 3 or 4 decades. Us older folks might not like that. I wouldn't tell a retiree that won't help them. But, when you're talking to your daughter or your son or a younger person, they really need to appreciate that. And you could even show it to them in their statements that if they're making a 401k contribution into the same fund they've been buying for the last 6 months or a year or whatever, they're going to get more shares for the same dollars. Now, some will say, by the way, I'll just, one other thing about this is a lot of folks will say on a day like today, oh, it's a buying opportunity. I don't see it that way at all. I mean, I suppose buying at any lower price is better than buying at a higher price. So as compared to before the market opened, I suppose you could say it's cheaper. So that's good. But to me, a buying opportunity doesn't mean that it's cheaper than it was yesterday. It means it's cheaper than its intrinsic value, which for most of us, myself included, we're not calculating. I couldn't tell you the intrinsic value of the S&P 500. I have no idea. But that's what, to me, a buying opportunity is when you're getting something at a minimum, you're getting it at a fair price, if not better. And just because stocks have gone down by 5% or 4% for the NASDAQ in one day, to me, doesn't mean it's a buying opportunity. It means it's cheaper than yesterday, but that's about it. Okay. So this is an interesting question that I'll read. I don't know that I have I don't know that I have a good answer, and I just want to make sure. I'm pretty sure I can't show it here. No, sorry about that. I am new to the U.S. and came upon your book. Oh, good. If there's any recommendations you could provide for someone in the U.S., I'm confused about all the insurance in the U.S. Well, welcome to the United States of America. I don't know how to, I don't even know what kind of insurance we're talking about, right? Car insurance, health insurance, life insurance, whole life insurance, long-term care insurance. It is confusing. I don't know of a book that I could recommend on insurance. If anyone knows of a good resource, maybe you could put it in the chat and help this person out. I don't know of one. I mean, you could Google, you could search, but I don't have like a recommendation for you, I'm afraid. So here's a good question from Andy. I get this frequently when the market goes down. If the market dips significantly, and they put in parentheses greater than 30%, then a lot of people would tune into the show. It'd be awesome. Do you think it's a good opportunity to do some Roth conversions or even add a Roth component to our 401k contributions? Well, I don't know what adding a Roth component, I guess you mean contribute to a Roth 401k in addition to a traditional. I'm not sure why. To me, that's a tax question, that part of it. Best I could think it through here on the fly. The theory behind doing a conversion when prices are lower is that every dollar of conversion will convert more shares, right? Because they're cheaper. So if you're contemplating a $10,000 conversion and you did it, today as opposed to yesterday, you'll end up converting more shares, assuming whatever your investment was down. And I get that, and there can be some logic to that. It's just that I think it's a very, very difficult thing to try to manipulate. I mean, for example, let's imagine you knew you wanted to convert for tax reasons. It's a tax analysis, right? Primarily, $10,000 this year. All right, should you do it now or not? Well, I guess it depends on what the market's going to do the rest of the year. I don't know what it's going to do. I suppose you could wait and see what happens. I mean, at the end of the day, I suspect that unless you're converting a lot of money, I just don't know how useful that kind of analysis would be, because you're trying to predict something you just can't predict, in my view. Anyway. Oh, here's a good question from Kyle. I'm sure you will stress tonight to keep calm and invest on. That's true. But has there been a time when you did panic sell after a bad day or event in your investing career? I'm confident the answer to that is no. I don't think I ever have. But I can tell you when I was the most concerned. But I didn't sell anything, and that was COVID. And the reason I was concerned was because, one, this is early, say March of 2020. We had no idea just what was going to happen with this pandemic. At least I didn't. I mean, maybe you had a better insight than I did, but we didn't know exactly how bad it was going to get, how long it was going to last. We were going into lockdown, and we were in a situation that I'd never experienced before, where a large percentage of businesses could not open. They just couldn't function. They were just shut down. And I just never experienced that. And so I was concerned. And a lot of people, pundits, predicted a really, really bad market. And I came out of that realizing a couple of things. One is just how hard it is to predict things. Because if I were guessing, I would have predicted the same thing. But the second thing that I realize is how powerful, at least in the short term, fiscal and monetary stimulus can be. And it's actually one of the things that gives me a little bit of concern for our economy going forward, because I still think there's a lot of stimulus working its way through the economy. Not the stimulus checks. I assume we've all spent those by now, bought your Bitcoin, whatever you did with it, I don't know. But, to state and local governments and other things, there's still a lot of money, and we're still operating at massive deficits. And I think as any part of that then starts to dry up, we're going to see some kind of contraction. I would think we would have to. But I would say I was most concerned during COVID, the first month or so of COVID. But I didn't sell anything. Okay. Let me come over here and see if I can put one on the screen. Dave says I might end up just playing more online chess. I have to tell you, my game has really not been great lately. I was rated over 2,000 in speed chess on chess.com. I've been in the 1800s now for like a month or so. I don't know what's happened. I guess I'm getting old. I don't watch a lot of business channels generally. I certainly don't watch I don't go on YouTube. I don't watch any other YouTubers unless one of you sends me a video to watch. I don't know. All right. Let's see. Here's a good question from Cactus Jack. Will holding 20% of equities in VTIAX, so you can, there's actually a logic, by the way, to a lot of these tickers. So let's see if we can puzzle through that one. So V is for Vanguard. I believe TI is for Total International. A is probably for Admiral shares, and X is for index. I think that's right. 20% of equities in VTIAX really make a difference in a 60-40 portfolio in retirement. Is there a way to calculate this effect? Well, yes, you could do a couple of things. You could go to, let's see, I'll pull this up on the screen here in a second. So we'll go to Portfolio Visualizer. Unless you're logged in and pay a fee, if you want to put your actual portfolio in, it's limited to 10 years of data. But you can go to backtest asset, and there's other tools you could use, but we could backtest an asset class instead of an individual like ETF. And so we could go to global excluding US stock market. And so we could say, we'll create two portfolios. Whoops. We'll do 40% US stocks. We'll stick with 40% bonds, and then we'll add 20% US global market, excluding US. And so we'll just call this US, and we'll just call this one international. And the first thing we can do is just analyze the portfolio. And this goes back to January of 1987. And I'm guessing the US one, yeah, it clobbered it. 8.82 versus 791. Now we could zero in on that. But it's been pretty consistent. I mean, we know the first decade of this year was better for international, and you can tell towards the end they got pretty close. But then it's been all US for the last more than a decade, right? But one thing you could do here then is go to settings. So what I did, I know I'm going through this quickly. Customize the data, go to settings, and you could say, all right, let's just put $1 million in to make the number a little bigger. Not that it really matters, but and then cash flows, you could say, oh, I'm going to withdraw if we're in retirement, right? Oh, and I'll take the comment off. Okay, we're going to withdraw a fixed amount. We'll use 45,000. That's a 4.5% withdrawal rate. We're going to adjust for inflation. We'll take it out annually. I guess you could do it monthly. You'd change the number, but in any event, and you could analyze this portfolio. And, in this case, obviously putting international stocks hurt you a lot. Now, the harder part is what's the takeaway from this data, right? Because in my mind, it raises big questions about the future. And yes, US stocks have clobbered international stocks in the last 10 to, I don't know, I guess 12, 13, 14 years, but is that going to continue? One thing I would recommend is that if you do this kind of analysis, is that you change up dates. It's interesting, they were neck and neck even into the 90s. But for example, if we come up here, I'm just curious, what happens if we say, this started in 87, but let's start in 2000. What's that look like? It's much, that's interesting. Oh yeah, annualized because we're withdrawing money from it. So a lot closer, but again, US is still clobbered them. So you could look at this and say, well, that tells us we shouldn't invest internationally. But again, I think the bigger problem is that I don't view the last 12, 13, 14 years as being the norm. I think one way to look at it is if you're happy with all your investments, you're not diversified enough. And so I always look for something to be unhappy with. And, lately I could look at international stocks, but we certainly know from history that there are long periods of time, including the first decade of this century, when international stocks have outperformed. I understand the arguments in favor of US stocks. One could argue it's already well priced in. But you could use this tool and play with the starting dates, and maybe you have a more a slightly different portfolio that you could model, and you could see. Okay. All right. Well, this is funny. Keith is terrified. I like it. Dave is unhappy that I said a young person would want the market to crash for 3 or 4 decades. Well, I mean, you get the idea. Yeah, that would be a hard 30 or 40 years. There have been bad times around the world. We were in the history class I'm taking, we were looking at Germany post World War I. And so, what happened is part of the treaty that was signed in Paris. Basically, Germany had to fall on their sword and pay a lot of money to the Allies, and they couldn't afford it. So they started printing money. And then, of course, that caused hyperinflation, which is one of the reasons, if you go back that far in your analysis, the safe withdrawal rate in Germany, not that I'm sure most people weren't thinking about this in 1923, but the safe withdrawal rate is abysmal because of that time period. So you can have pretty bad things happen for long periods of time. Anyway, that was a different situation. All right. I try not to skip over some, but let's see. Another name says I have a pleasant voice for a podcast. Maybe I have a face for a podcast as well. I will tell you that when I started this channel in 2020, and when I started my first podcast, which was 2013, one of my biggest concerns was my voice. I don't know why. I was worried that it just didn't sound right. Okay. Now here's someone, Vincent. I don't know if this is a question. I guess it is. I went all cash in my 401k in mid-February in a money market account earning 4%. I'm going to slow average in when the market bottom. Am I doing the right thing? Well, you've probably come to the wrong channel, the YouTube channel. Here's the problem. How will you know when you hit the bottom? How will you know when we're at the bottom? That's the problem. To my way of thinking. In theory, it's great. I want to sell high and buy low. So if I knew that we were in for a 25% decline from now to the end of the year, would I sell? Of course I'd sell. And I'd wait till we got to that bottom and I'd buy again. But we just don't know that. And I've been surprised, shocked, completely fooled by the market, by interest rates, by inflation. So many times things happened that I just wasn't expecting, that I've just learned that I can't predict these things. Okay. Oh, let's see how, let's go back to the so mildly concerned still won. There were 1,700 votes, and they're still coming in. 35% are mildly concerned. Yeah, I would say that would probably be me, mildly concerned. I don't get to vote in my own poll, by the way. I can't vote anyway. All right. Remember to tag me in the question if you can, because then I can just sort of skip through. Here's a good question from Mark. When was the last time the S&P 500 closed at today's closing price? I don't think it was that long ago, actually. Let's see here. I'll pull this up in a minute. Yeah, so let me make this a little bigger if I can. This is just the Apple stock app. By the way, I don't own all these. I just track a lot of different things. So it closed. Let's see. We're at 56.14. We were at, what's this? 55.54 in September. Yeah, so it hasn't been that long. And if we went back, we were down to in the 4,000s in April. So that I do find that kind of perspective helpful until it's not. Eventually, you might have to go back a lot further. Okay. So with a handful of mostly tech stocks dominating the S&P, is there an alternative fund that excludes these? Well, sure. Yeah, you can do a couple of things to either minimize their impact on your portfolio or to completely exclude them, right? I'm not necessarily saying those are good choices to make, particularly the completely exclude them. At least that's not a choice I would make. I guess in a way, blunt their effect a little bit, although my shares of Apple probably don't help me, in that I have about a 10% allocation to small cap. So that would skew my portfolio a little bit smaller, but not a lot, but a little. They have extended market. So you could invest in a fund that's just a mid cap and a small cap, one fund or two funds. Let's see here. Let's see if I can find an example. So this is probably an example. I'll show you how you can make sure. So this is an ETF version of Vanguard's. Normally extended market is basically everything but the S&P 500. Okay. And if we go to portfolio composition, I actually want to, you can see here, this doesn't mean that all of the companies are in this box, which is mid-sized companies. That's sort of the average, right? And we can take this ticker, which is VXF, and go to Morningstar and look it up. And what I would do, you can see it here, it's very inexpensive because it's a Vanguard index fund, so that's what we would expect. Go to portfolio, and you can actually, I like hitting the weight option. So you can see it actually does have a little bit in large cap, but very little. Majority of it is in small cap, and then there's some in mid cap as well. So this would be an example of one. Let me pull the comment off the screen so you guys can see it all. And if we went down here, we could see the top 30 holdings. And you can see, that they don't have Meta, they don't have Alphabet, they don't have Microsoft, they don't have Apple, they don't have Tesla. Although if Tesla keeps sliding, they may eventually have Tesla. Yeah, so that would be another way to do it. Again, my preferred way, and I'm not suggesting this is the best or right for you, but I personally would never exclude the big companies, in part because I want my portfolio to sort of match the market, or at least closely. I've almost always had an allocation to small cap, and it's just gives me enough interest in my portfolio. I mean, again, sometimes that's going to work out better, and sometimes it's not. Long term, I would say it's generally worked out to have some additional exposure to small cap, although not recently. So there's that. And if you say, well, Rob, it kind of sounds like you don't really know, I would say, welcome to the channel. Yes, that's not knowing. It's important to know what you don't know, I think, because then you don't make decisions based on a false belief that you do know. And so when you don't know, you basically mirror the market. Again, you may tilt it a little bit towards value or maybe growth or maybe small cap, but Yeah, I don't know. I don't know what's going to end up doing the best. I'm not sure I follow this question, but I will try. It's from Keith. I sold out of my stocks and ETF except for Berkshire. All were for a loss except for Berkshire. Do you think leaving the money in there and transferring it to my Roth IRA for 2026? I guess I don't follow this. So it's a taxable account. So you can't convert money from a taxable account into a Roth, right? I assume you know, like you could if it were in a traditional IRA. You could make a Roth IRA contribution in 2026, right? Oh, well, assuming you meet the rules and your income doesn't disqualify you, and you have earned income and all the other things. So yeah, I mean, I may be misunderstanding your question, and if I am, I apologize. What is this? Is someone sending me an email? Noreen, what's happening? When Noreen emails me during a show, it's not good news. Okay, I see it now. So I'll look into that. So I get emails from folks periodically that say they're not getting the newsletter, which goes out every Sunday morning. It's free. There's a link under this video. You can subscribe, or actually there may not be, but there will be a link. There's a link under every video to subscribe to it. For this video, I'll put it in after the show's over. I would say most of the time, it's because the email is going to the person's spam folder. So you could always check that, but I will look at this after the show. Yeah. Okay. By the way, I love putting that newsletter together. I have to be honest, my favorite parts of the newsletter for me are finding fascinating articles that have nothing to do with investing and retirement. It's kind of funny, but I'm glad I put that section in. It's an in case you missed it. That's what the acronym stands for, if you guys were wondering. And why I called it that, I have no earthly idea. You know, I reached out, by the way, to both Bolton and Projection Lab today, and I asked them both, do you have any plans to introduce AI into your tool? And they both, they emailed me back, and I need to follow up. But what I think would be cool is if, and there's privacy issues, so you have to think about that. But if AI were baked into these tools and you could query AI based on all of the data in your retirement plan or your financial plan, and I think some apps, not in the retirement space, but are starting to do that. But I think that would be a really cool thing and helpful. And I think AI could do a lot to help us better understand our retirement plans. But I don't know that it's going to happen anytime soon. I have to be honest, but I'm trying. I'm not sure. I'll try to puzzle through this one from Fast Eddie. I have 3 years to add to my Roth before retirement. Would you do that, or start transferring from your 401k and paying the taxes with that money? So I think the question is, would you do Roth contributions or a Roth conversion? I think. And I'm assuming you can do that in your 401k while you're still working there, but that's an assumption that may not be correct. And so I'm not sure I'm understanding that question, but in the end, if you're talking about the same amount of money, either way, you're going to end up with, I don't know that there would be a difference. I think you would end up, assuming we're talking about contributing or converting the same amounts of money, and if you did conversion, I guess I have to say I'm not sure I follow that question completely. That's my final answer. I'm sorry. See, if I were AI, you could just keep asking the question and you'd eventually get to the answer you wanted. So Bob wants to know, how do you protect a portfolio from downside? So I would say the standard way is diversification, including bonds. It doesn't eliminate downside, but it softens the blow. Now, what some will say is you can buy insurance. You can buy puts, for example. I suppose you could invest in some sort of inverse ETF, although I don't know that that's a great way to go. The problem with buying insurance, when the market's down like it is today, I mean, if you've bought insurance, which is effectively what you're doing if you're buying puts, it sounds great. The problem is it's very, very expensive. And unless you just pick and choose and you don't buy insurance all the time, but then how do you decide when to insure and when not to insure? And so I find the best way is to just have a well-diversified portfolio and then leave it alone. But you will see drawdowns. That's just the reality. Even with a 50-50 portfolio, you could see big drawdowns. I think another way that I insure against drawdowns, and this is maybe indirectly, is try to avoid debt as much as possible. When you're getting towards retirement, try to be debt-free and oversave a little bit. So there are costs in oversaving, right? It's foregone opportunity to, I don't know, buy a new car. But that's an approach that's worked for me. Okay. What is next? I see a lot of good comments on what you guys think is going to happen to the economy, which I guess I should just double check the live stream. Man, 2,100 votes, and they're just flying in. That's unreal. Still at 34%. I'm going to, I wish I could keep that poll running. Can I do 2 polls? I don't think I can do 2 polls. No. I will end it. And I'll ask another one. How are you dealing with your concerns? I was going to say fear, but I'm doing nothing. I guess that would be me. I'm selling stocks. What else might we be doing? I'm saving more. I wish I could put one in here where you guys could just type in your own answer, but I can't do that. What else should I say? I'm doing nothing. I'm selling stocks. I'm saving more. I want to this one's kind of an oddball one, but looking for a different job. And that could be for a lot of reasons, but I'm going to put that in there. And I can only do 4. So we'll see what happens with that. Okay. Lou wants to know what I think will happen to the Fed funds rate. Well, keep in mind that I have no clue. What I've read today is at one point they thought there'd be one more interest rate cut this year. And then with this concern that maybe unemployment, because the Fed has a dual mandate, right? They want to keep prices stable and they want to keep unemployment low. And those things don't always go together, right? But the thought is if we can keep inflation where it is, but maybe unemployment rises, we could get up to 3 cuts this year as a way for the Fed to try to encourage employment. At the end of the day, I have no clue. I really don't have any clue. And again, for that reason, I don't make any investing decisions based on a view of what interest rates will do in the short term or the long term. Really, we've also seen, by the way, that just because the Fed cuts doesn't mean they're dealing in short term rates. Intermediate term and longer term bond markets have a mind of their own. They don't have to listen to the Fed. So this person, let's see. Greg wants to know my view on REITs. Says, I know they don't go into a taxable account because they're just, they generate a lot of taxable income. The way REITs work is they have to distribute, I think it's 90% of their income every year. So that's one of the reasons you'll see a lot of REITs with pretty decent yields. Anyway, what percentage of REITs might work for a 60-40 portfolio? Well, 60-40. I can tell you at one point, I allocated 10% to REITs for a long, long time. Now, my portfolio then was probably 80-20, maybe even 90-10 at one point. I've since gotten rid of REITs. This was a while ago. And it wasn't that I think REITs can be a good way to diversify your portfolio. What I decided, though, was that, when you have a total, say, U.S. stock index fund or an S&P 500 fund, you have REITs in there, right? Those funds own REITs. If we look at, I'll just pull up VTI, Vanguard's Total Stock Market Index Fund. And if we go to portfolio and we go to sectors, it's not much. 2.5% are in real estate. But that includes REITs, right? And although I would say that's an understatement, because a lot of companies that would not be classified as real estate have significant exposure to real estate and have significant holdings in real estate. But what I just decided was, that's enough for me. If that's what the market is allocating to REITs, I'm fine with that. Now, if I were going to add REITs and I had a 60-40 portfolio, I probably wouldn't allocate more than about 5%. That would be my choice. I'm not saying it's the only choice or that it's even the best choice. Give or take. And I've thought about putting money into REITs, partly because of valuations and just diversifying out of the U.S. stock market. I mean, I understand REITs are publicly traded, but I guess sort of a way to diversify out of all of the high growth tech stocks. But I didn't do it, and I don't have any plans. I mean, it's one of those things I just, I sit around during the day and I try to think big thoughts. I wonder if I should put some money in REITs. I'll think about it for a couple of days. I usually don't do anything. Just like I was going to buy the coal company that's up 6% today. I thought about that I was thinking about it today. In fact, Monish Pabri, I think Pabre, I may be mispronouncing his name, but he was interviewed, and I've been watching his interview. He's a value investor, knows Warren Buffett. Let me pull up. I've read one of his books. See if I can. It's probably going to start playing. Wow. Well, I got to get through. I got to get through the ad. Hang on. I'll show this to you. I've watched about 20% of it. It's a long interview. It's a couple hours from 9 months ago, but here it is. And here's the title down here, so you could just find it in YouTube. But a very smart guy. He's done very well. Value investor. It's interesting. I was looking at his portfolio on Datorama. Let me pull that up. You won't believe this portfolio. You talk about being a little nervous. Oh my goodness. Let's see here. I'm going to have to search for it. Where'd it go? Huh. I just looked at this today, I would swear. Oh, I miss it. It would help if I spelled his name correctly. So this is his portfolio. Now, this is, I think, an investment fund that he runs, I assume. But he has 253 million, and he's got 3 stocks, including 2 coal companies. Well, and a metallurgical resources company. Can you imagine? All right. That's scary. So 73% of you aren't doing a thing. 18% are saving more, 7% are selling stocks, 2% are looking for a different job. Yeah, I'd say that seems about right. Yeah. All right. Back to the show. So Lynn wants to know, if you're planning to retire in 5 years, would it be wise or unwise to add more shares of an S&P 500 fund? Well, the way I would think about it is, what is my current asset allocation today? What do I want my asset allocation to be in 5 years when I retire? And then come up with a plan to get from where I am now to where I want to be. Now, as part of that analysis, I would be thinking, if stocks really take a beating, what are the consequences for me and my retirement? For some, it might be, well, I'm in pretty good shape. I could probably still retire. For others, it might be, I might have to work a few more years. Or for some, it might be, I don't really have a choice. I have to retire in 5 years, but I'd be in trouble. And so, the question becomes, what that could influence the decision about what your asset allocation should look like in 5 years when you retire. And the hard part about this, I think, is that if you're like me, you're looking for an answer, and there is no one answer. It's as much art as it is science. We can certainly look at history and come to some understanding about what a reasonable portfolio looks like in retirement, particularly if you need to live off of 4 or 5% of that, say, each year, adjusted for inflation. What we know is that probably the worst thing you could do is have too much in bonds, because you could think, well, I'm going to go real conservative and maybe only have 25% stocks and 75% bonds. It's just as an example. But history tells us that can really get a retiree into trouble, because bonds just can't keep up with inflation. They get pummeled over time. But we also know that if you go 100% stocks, that can be a big problem, particularly if we relive the 1929 stock market crash and the subsequent fall of stocks over the next 3 years. They were down 80, 85, 90%, depending on how you measure it. I was actually looking at a paper today. Let me see if I can pull it up. Yeah, here it is. So here's the paper, how the 4% rule would have failed in the 1960s. And in fact, I may do a video on this paper. So again, you could just Google this if you wanted to look at it now. I do plan a video, because not on the whole paper, of course. It's 42 pages. But one thing that I found interesting, let me see, I'm pretty sure it's this paper. Let me make it a little bigger. I was looking at several today. Not that one. Oh, that's a good one. Yeah. So what this paper did here, starting here, is, a lot of these research papers, some will go back to 1871, others go back to 1926. And if you wonder why those dates, it's because of the data they have available. One of the things this paper did right here is said, hey, let's not go back a century. Let's look at current times, because that's what's relevant. So how would retirements have worked out for someone starting in January of 2000? Now we're not at 30 years yet. We're in the year 25. But we know we had the dot-com crash, and then we had the financial recession and COVID, and what this paper did, what this author did, was looked at a couple of different portfolios. Looked at 100% stocks, 60-40, 30-70, and 100% bonds. And these are all, using basically what Bill Bengen used, S&P 500 and intermediate term bonds. And then they also looked at some new investment products that weren't available, going back certainly 100 years, right? Or even when Bill Bingen was doing some of his research. And he figured out how much they'd have left. I don't know if what the starting value was. If it was 10,000, I have to look at the paper. But he then projected how many years they have left, which is a guesstimate, and what he expects their total, how long one of these portfolios would have sustained a 4% withdrawal rate, adjusted for inflation. And you'll notice here, 100% stocks in this traditional bucket was the worst performer. And, you think about the dot-com crash, the Great Recession, COVID, 2022. Again, it wasn't horrible. His best estimate now is it'll just be under 30 years, but much, much lower than portfolios with bonds. Now, again, I'm not suggesting this will always repeat itself, but I would say these findings are not all that unusual. There are certainly periods of time where you would have crushed it with 100% stocks, but there are times when you'd take a beating. And you can see some of the interesting thing about these funds, in my view, is that the quote unquote safe investments, like a treasury money market, it's already run out of money if that's what you invested in. And by the way, you go back to early 2000s, this was like 5 or 6% was the return. The G fund, which is part of the thrift savings plan, you're not going to quite make it to 30 years. Interestingly, a total bond fund, which is a Vanguard fund, that's what he's using, he projects will last almost 35 years. That surprised me. Anyway, I kind of given away. That was sort of the topic of my video I plan to do. No one's going to watch it now. I don't know if that'll help, Lynn, but I think of these things as I think about what my allocation should look like in retirement. And I do come out somewhere between, for me, probably between 65 and 75% stocks. Again, I'm not saying that's right for everyone, may not be right for you. But I think that's how I would think about it as I'm approaching retirement. What's my end goal? How quickly should I get there? And then that would then decide what I invest in, during those last 5 years of work. At least I think that's how I would think about it. All right. Oh, here's a good one from John. Whoops, this one. Going to my investment journal has helped me with fear. Last entry is 2022 and sounds quaint 2 years on. John, I think that's a fantastic idea. I've kept notes from time to time in my note-taking app. I don't do it consistently as it relates to investing, but I think it's good to it doesn't have to be anything extensive. One sentence for today, stocks down, blah, blah, blah. Here's how I felt about it. And if you do that long enough, you'll be able to revisit that. And I think it can help ground you in the moment. Cold Dark, I guess this is in reference to the poll I did. A good option would have been, ending my retirement and going back to work. That's a great question. I'm going to ask that separately. Although the votes are still pouring in, but most of you are doing nothing. The percentages haven't changed. Okay. I'll just make this a yes/no one. I'm just curious. Have you left retirement to go back to work? I guess you could include, I'll say I got yes, no, and I'll say partially got a part-time job, because that's probably for a lot of folks. I don't know if I spelled that right, but we're gonna post. That's a great question. Chase wants to know my view on holding dry powder, that's what the folks call it, or a cash balance that has some set of rules in an investment policy statement to deploy into the market. My view on that is that for the vast majority of our portfolio, which is index funds, I just don't do that. I've got a bond allocation. I've got a very diversified stock portfolio, and I just don't feel that would be useful to us and to me. if to the extent I'm investing in individual stocks, which I'm by and large not right now, but if I were, I could see sitting on cash while I waited for a stock I wanted to buy. But yeah, but that's not something I'm generally doing right now. So, but that's how I think about that. Stephen wants to know if I still like SPAXX. I like it. So SPAXX is a Fidelity money market fund. It's not the highest yielding on an after fee basis. That probably goes to Vanguard. But for the cash management account, you can write checks and whatnot off of that account, and they will automatically sell investments in SPACs, and that's or any of the, I think it's any of the Fidelity money market funds, to clear the check. So I effectively keep in our quote unquote checking account, I keep it in SPACs, money that I'm going to spend in the very near term. The great thing about the Fidelity cash management account, though, is you don't have to keep it all in that. Like, you can invest in whatever you want. So I have some SGov, which I don't even know what the yield is now. It's an iShares, treasury, short-term treasury bond fund. It's really inexpensive. It's got an SEC yield of 4.20. I think SPACX is something like, it's under 4, I think, or right around 4. And this is comparable to what I think most of the Vanguard money market funds are paying roughly. Some of them might be a tad bit more than that, but so that's how I think about SPACX for what it's worth. Steph says, how I'm dealing with the market crash, watching your video. I like it. All right. Is it 8:12 already? My goodness. Have you guys been watching any good TV shows? You got to put that in the chat so I can see that. I have mixed feelings about the current season of Severance. I'm through, I don't know. I think I'm 1 or 2 episodes behind. I don't know. It's too almost dystopian. I don't know. It's just, I really loved the first season. I'm not sure about the second one. So Howdy wants to know about VWRL. I have no idea what that is. Vanguard whole. I don't know what it is. I won't even guess. Well, Morningstar doesn't show that as a ticker, at least that I can find. Hang on. Oh, it's the Vanguard FTSE All World. UCITS ETF. UCITS. I don't know what that is. Oh, this is a UK fund. Not that there's anything wrong with the UK. It's just, this is not one that I'm familiar with. Morningstar does have it. It's funny how Morningstar won't show you, I guess because, I don't know, it's not a US fund. I don't know. Anyway, here it is. Doesn't show an expense ratio. What's the portfolio? It's not, it's a 100% equity portfolio. Let's see here. I want to go to region. So this just, yeah, it looks like I wonder if it's very similar to VT. It might be. Let me, we're going to pull that one up. What I want to compare is, yeah, it must be because it's 66.98 North America. Yeah. 11% Europe developed. Yeah. So this is VT, but for folks in the UK, I guess. I mean, it's almost identical, not completely, but very, very close. Price to earnings is 18.5. Yeah, 18. So I think I think VT is a good fund. So I mean, it seems like this fund, VWRL, is very similar to it. I've owned VT in the past. I don't now, but not because of any issues with the fund. All right. Steve wants to know, is there a specific reason I picked VTINX to your portfolio and did not choose VWIAX? No, I don't know. Oh, yeah, there would be. So VWIAX is Wellesley, and it's been just a phenomenal fund. What's the portfolio? Is it 35% stocks? 32. So I could have picked this one. I generally just prefer index funds. I prefer index funds. I know that Wellesley and Wellington, right, that's a little more stock heavy, have had just, two of the oldest funds out there, and they've just had an incredible multi-decade run. And I think these are reasonable choices. And I just am more comfortable in index funds. Yeah, that's it. That's my reason. So Sean wants to know what we can expect from our short and medium-term bond fund returns if the government shuts down and a rating agency or two decides to downgrade our debt. That's a good question. I still find it hard to believe that the U.S. government would default on their loans in the context of a government shutdown. But it could happen, right? I suppose anything could happen, and we could get downgraded again. We're just speculating here, but I would think, at least at the moment, probably not much would happen. If and I'm focused on the downgrade right now, in part because there aren't great alternatives for safe, secure investments, and we've almost come to expect this sort of battle, if you will, with shutting down the government. It's really nothing new. I mean, this goes back decades where this has been an issue. It probably feels worse now just because we're living in the moment. But they've gone back and forth on these battles as long as I've lived in Northern Virginia, and it affects us in different ways. I will say that when I was working downtown, I wasn't working for the government. Government shutdowns were great because, I mean, there's no traffic. I just zipped right into work. But it wasn't really great. I guess my answer to your question, Sean, is that I'm not changing how I invest. I'm not pulling money out of a bond fund that includes U.S. Treasuries or my short-term, SGov fund because of an impending government shutdown. I can't tell you that our government couldn't default on or have some issue because of the shutdown. Although the shutdown in and of itself, normally it comes up with when we hit the debt ceiling. I don't know if a shutdown itself would cause any issues, but I could be wrong. It's happened before, as my wife will remind me if I get a little too full of myself. All right. So why self-manage over picking a target date fund? Well, I suppose in some ways a target date fund is still self-managed, right? You're picking the fund, but I get what you mean. Well, in the taxable account, I've owned we have 3 yeah, 3 index funds in our taxable account that have gains in them. So even if I wanted to simplify it, I wouldn't sell them, and I also wouldn't own a target date fund in a taxable account because I just don't think it's tax efficient. So I just wouldn't do that. Now, that being said, in our traditional retirement accounts, we do have a target date fund, right? VTINX. So I can pull it up. It's Vanguard Target Retirement Income Fund. It's a very conservative fund. My reasoning behind this particular fund, it's only got about 30% equities, but when we then add in our Roth accounts and our taxable accounts, it brings me to the stock bond allocation that I want, which is roughly 75% stock. So we do actually own a target date fund in our traditional retirement accounts. Now that's fairly recent, and I did it in part largely just to keep things simple. RJ says, early in the show, you said this might be a time to rebalance and buy stocks. I don't remember actually saying that, but maybe I did. You also said you were doing nothing, sitting tight. Well, based on today, I don't need to do any rebalancing just because of today. But I would rebalance. I mean, if stocks go down enough, I'll sell bonds. Well, it's interesting. If stocks went down enough, I might have to make changes to that target date retirement fund, but keep in mind that target date retirement fund itself does the rebalancing for me. So I would have to keep an eye on that and see if I needed to do any additional rebalancing. I would hope I wouldn't, actually, now that I think about it. So yeah, it does it for me. If I had to do some additional rebalancing, the thing I would avoid doing is triggering new taxes in a taxable account. And so how I would get around that would depend on what I needed to rebalance. Okay. Where am I? I'm at 8 o'clock on the chat. No, 8:10, 8:09. I'm actually not far behind you guys. Lance wants to know if I enjoy living in Virginia. Yeah, for the most part, I do. I think there's a lot to do, beautiful, a lot of trails in Northern Virginia, near DC. It's expensive. After a while, you just sort of get used to it. The commuting was hard on me. I don't commute anymore. This is my commute. I walk down to the basement. I remember one commute I had, and those that live in Northern Virginia, you'll know exactly what I'm talking about. I would walk from our house, not where we currently live, down to Braddock Road, which was not it was a third of a mile. Cross Braddock Road, that in and of itself can be dangerous. Get on a bus. Well, sometimes I'd get picked up in the slug line. That's just basically where you're hitchhiking, so you can get at least 3 people in the car, so you can get on the HOV lanes. Now, I'm dating myself a bit because now you can just pay, but normally I'd get on a bus. The bus would drive me down Braddock, onto the Beltway, onto 395, and up to the Pentagon. I'd get out at the Pentagon, get on a metro, which is what we call the subway, and take the subway into DC. At night, particularly if I left late, I would reverse all of that, except that when I got on the bus, it would do this long route through Landmark Shopping Center, which now has been torn down, and it could take me an hour and a half to get home. I did that for decades. It's miserable. Anyway, but yes, having said, other than that, I do enjoy living in Virginia. So Braxel says, what program or spreadsheet should I use to figure out my asset allocation? Well, if you want a way to sort of connect all your accounts and just see your asset allocation, I think one of the better ones is Empower. And I can show you what it looks like if you'll bear with me. Maybe I can. I don't think I can show you tonight. I gotta do too many things to get in. But I've done videos on it, so you can just go to the YouTube channel and look up Empower. It used to be called Personal Capital. It's free. It's part of their marketing effort. So it's a great tool, actually. And then what they want to do is call you and then sell you on their investment services, which you can take the call or not. You don't have to be a client to use it. I've used it for over a decade and have never been a client, but it's a great tool. I do have a spreadsheet. If you just Google best investment tracking spreadsheet, I just came out with version 2, which I think received mixed reviews. It is a bit complicated, but both versions are available. You could use that. It's free. It's just a Google spreadsheet, Google Sheets. You have to do a little bit of work. It's not as easy as just connect. You can't connect your accounts. But that's another option. But Empower is probably the best option to, like you said, you've got accounts all over the place. It can connect to 401k, an IRA, HSAs, taxable accounts, and it will show you all of your asset allocation. It'll show you calculate your fees and the effect they have on your portfolio long term. It's a pretty good tool. Okay. How do we do on the poll here? Are people going back to work? Not really. Some. 4% went back to work. And 6% got a part-time job. And, if you have that flexibility, it's not, it might not have been plan A, but, it can be a great way to sort of de-risk your retirement plan. Even if it wasn't, what you planned to do. So this is an odd question. I'm looking at it over here. I don't think I can show it, but it says, how is your son doing with his dog? The story you wrote about him was inspirational. My son doesn't have a dog, and I didn't write a story about him and his dog, so I have no idea what that's about. What are your thoughts? We're getting near the end here. It's 8:27. Okay, this might be the last question. I don't know. I'll scoot to the bottom of the chat after this question. Maybe there's some non-financial questions. Those are my favorite. What are your thoughts on an estate trust? Do you have one? How about a video on trusts? What I should probably do is get a trust and estates expert to come on and do a live show. Because they're immensely complicated. They vary from state to state. And so I do think they're important. A lot of folks have living trusts, and they serve a number of purposes. They can help you avoid probate. They can help you sort of control how folks inherit money and the control they have. And there are a lot of different kinds and ways to structure it. It can help with estate taxes. Again, very complicated topic. And for many people that may not be necessary, depends on your circumstances. But obviously a very important topic, by the way, and not just a living trust and a will, but end of life documents, right? Medical related documents, I think very, very important. But probably I need to bring on an expert. If anyone can recommend anyone, shoot me an email. I'll take any recommendations you have. Jonathan is watching storage units on YouTube. That seems about right to me. That makes sense. All right. So this is I guess it's kind of a financial question. What are your thoughts on a car? So if I were going to buy a car today, this may be very unpopular right now, but I'd probably strongly consider a Tesla. I like the self-driving part of it. Isn't it the best at self-driving? Are there better? I don't know. Oh, Wine Guy says there was an estate attorney on the Bowhead podcast, I guess. Oh, no, the conference. I'll have to look that up. Well, I'll push back on this a little, Jonathan. Trusts, you can use, You can use a couple can use a revocable living trust to deal with estate taxes in ways that can be beneficial. Yeah, but generally, that I don't disagree with what you're saying, but it can have an effect on estate taxes. All right. So Noreen, is this Noreen's? Oh, Lexus fan. That's not the one I wanted to click on. Where's Noreen? Oh, here we go. Teslas are ugly compared to other EVs available. I think that's true. I've never thought that. I mean, I think from the outside, Teslas are okay. Inside, they're too minimalist for me. But I don't know of any that do the self-driving as well as they do. Although Blaze describes the self-driving of a Tesla as a kid with a learner's permit. I don't know. The people I talk to that have Teslas and do the self-driving, they love it. But I don't know. Maybe I've test driven every Tesla. I ordered the X during COVID, and thank goodness I canceled it because then the prices dropped, and I got a Honda Odyssey. It's functional. All right, I will end the show with this question from Brian. Sorry. I read your book on Retire Before Mom and Dad. It has absolutely changed my perspective on how to invest and save. Glad to hear it. Any advice for a 17-year-old young man, a boy? What advice would I give to someone who's 17? Well, the first thing, I guess, in the context of my book, I would say that I would start saving and investing now, number one. I should assume if you have a job. I had a job, I had a paper route, cut grass, and then the day I turned 16, I had my learner's permit, and I drove with my mom, because in Ohio then you had to be 16 to get like a real job, like at a fast food place. And I got a job at Mr. Heroes, and I worked there for a couple of years, usually closing every night. I would work until midnight or 1 in the morning and then get up and go to school. Maybe not the smartest thing, but and then I ended up getting my dream job at Kroger's because I was making $3.35 an hour at Mr. Heroes, and I got a raise to $3.40. That was big time. Now, unfortunately, I had to become a member of the union. Not that there's anything wrong with that, except that it cost me more than my raise. So it didn't work out. But I didn't save anything. I worked in college. I did some work in law school, and I didn't save anything. I really started saving when I got out of law school. It was very important to me. But I wish I would have been more focused on saving and investing as a high schooler and even in college. Because one of the things you have is time, and that's the most powerful part of compounding. We talk about which index fund and your asset allocation and stocks and all these things, and these are important questions, but boy, I'd trade all that in for time, even in the context of investing. And so that's the first thing. The second thing, the only other thing I'll say in terms of someone who's like in high school is that the tough part about being in high school and graduating is that you have to make decisions, really important decisions that can affect the rest of your life. Like, do you go to college or not? If you do, where do you go? What do you study? If you don't, what kind of job do you get? And often you don't always make these decisions for the best reasons. I mean, you do the best you can. But I think a lot of folks end up making decisions that by and large, we figure out a way to make them work. But if we could do it over again, we might do it differently. I have no regrets, but if I could do it over again, I would do it differently. I was an English major with a plan to go to law school, which is what I did, and that worked out. But if I were graduating high school today, I would not get a degree in English. I would probably get a degree in computer science, and maybe some form of this would be purely out of interest, but some form of physics or astronomy or something, because that's just my interest. But in terms of career, I'd probably gotten a degree in computer science. I still may have gone to law school, but I would have gotten a degree that I would have enjoyed a lot more than English, and that was more useful. And I think my advice to someone getting out of getting out of high school or close would be figure out what you love, and then follow it as long as I wouldn't ignore the practical side. So like if you told me that whatever you loved, you couldn't make a living out of it, you got to figure out how to make a living that you're going to enjoy. So that there's a practical side of this. It's not just follow your dreams. It's, in my view, I mean, that's part of it, but you want to do something that you love. In fact, in that interview, this one that I showed you, that I recommend, I'm still watching it. He talks about Warren Buffett when Warren Buffett was younger. You're a kid, and it's fascinating. I even if you don't watch the whole interview, watch that part of it. It's the first part of the interview. One of the things that Warren Buffett did, he read Benjamin Graham's book. Let me pull it up. I think the one he read was the Intelligent Investor was the one. Here it is. And when he read it, he didn't even know that Ben Graham was still alive. And he found out that he was, and that he was teaching at Columbia's business school. And so he applied to go to Columbia because he wanted to learn from Benjamin Graham. And then after he graduated, he wanted to work for him. And he was even willing to work for free. Now, not everyone has that luxury. He was willing to work for free. And Graham at first told him no, for interesting reasons that I'll leave for the video if you watch it. But eventually, Benjamin Graham said, fine, come work for me. And so Buffett didn't ask about salary, benefits, nothing. He hopped on a train. He went to New York, and he worked for his idol, his hero, and learned from him. And again, not everyone's going to have the luxury to go work for someone. He ended up getting paid, of course, but we might not all have the luxury to just do that exactly. But the thing that I took from it was that, one, Warren Buffett was doing something that he had a tremendous passion for. And his focus was learning and working for someone who he could learn from. And that was his number one priority, even above money. Again, you can't ignore the realities of money. We all need money. But I think, I'll give you one last example. It's already 8:38. There's probably no one even watching. I'm probably talking to nobody. When I was in law school, I wanted to be a trial lawyer. That's why I went to law school. I wanted to, Perry Mason. And if for lawyers that are watching, this, if you go to a big law firm, which is what I ended up doing, you're unlikely to be a trial lawyer. Right? First of all, you deal with cases that are so large. Discovery takes years, and you might take hundreds of depositions. I did. You might argue all kinds of motions. I did, but you're probably not trying a lot of cases. Now there could be some exceptions, but by and large, you're probably not. And so in my career, I worked for 25 years as a lawyer. I was a litigator. And I think I tried 5 cases, 6 cases. Now, some of them lasted a long time. I did 2 arbitrations, 1 jury trial, a bench trial, an administrative hearing, 5 cases in 25 years. I never became a trial lawyer. Now, I don't, lie awake at night distraught over this fact. I'm happy with the career that I had. But when I was in law school and I was looking for jobs, you become what's called a summer associate between your 2nd and 3rd year, and then hopefully you get a job from that, which is what happened with me. But I had an opportunity to interview for the Justice Department to work in the tax division, and one of the benefits of that was that you tried a lot of cases. Now, you weren't trying huge tax cases to start, but if you wanted to be a trial lawyer, there's other ways to go about it, by the way, but that was one of them. And I didn't even really consider it. Why? Because of the money. Now, in fairness, I had a lot of school loans. I had a lot of debt. It would have been hard because you're probably talking about half the income. And we were barely getting by with the income we ended up getting because of all the school loans. But if I were passionate enough to wanting to be a trial lawyer, I would have figured out a way to make it happen. And I didn't do that. Again, I don't have profound regrets, but I guess this is a long-winded answer to a simple question. Maybe it's not so simple. Is that, I wouldn't just say follow your dreams, because that can lead you down paths that just may not, for practical reasons, be very pleasant. But I would also say don't ignore your dreams. Know what they are, know what you want to do, and work hard to be able to pursue them, whatever that looks like for you. Okay, that's my advice. I don't know how good of advice that is, but that's my advice. So wasn't tax law pretty dry? I find tax law fascinating. I wouldn't have found it dry at all. I like working with numbers. When I worked for the Public Company Accounting Oversight Board in the Enforcement Division, I loved that kind of work. You talk about dry. Whew, you're just basically sifting through spreadsheets. But that was my favorite job. That was my most fun I had as a lawyer. I enjoyed other things too, but I really enjoyed working at the PCOB. Okay, I've talked enough. I'm parched, I'm dry, I'm tired. It's 8:41. I'm going to go. Have a great week. I will have some more videos out this week. I'll do 5-question Friday on Friday, so you can send in questions. And I've got hundreds, so I'll do my best to, work through them every Friday. And I guess that's it. So have a wonderful week. If the market's down tomorrow, just ignore it. And until next time, remember, the best thing money can buy, and it helps on days like today, is financial freedom. All right, everybody. Have a good one.